Hey, how's it going, guys? Welcome back to mentfx, and in this video we are going to deal with structure and how structure becomes liquidity, when structure becomes liquidity, and when to stay out of a structural play that you think might be unfolding. This is also going to go hand in hand with, for instance, finding certain supply and demand zones that you want to see trades from, and those trades that end up tapping into those zones and picking up the orders within that area, especially since we have imbalance, right? So remember, imbalances usually dictate how good a supply and demand zone is, because what it does is it shows us an inefficiency between supply and demand when those sells before the buy-ups happen. So inside of there, clearly you all understand we have lows that were ran and we continued higher, and that continuation from that sell to buy happened so quickly and allowed them to make so much money on the up move to the top side that they weren't able to fully close their sell positions, which means even up here they were at a very, very large negative loss, that being smart money or the composite man. So when they made their imminent way back towards this specific supply and demand zone, and we're going to speak about this in a second a little bit more in depth, but the second we made our way back there, the reason we did that and the reason we had this little bit of a push was because we were mitigating whatever orders were left inside there. But how come this zone wasn't the one that wanted to hold price up and allow it to continue making new higher highs and higher lows? Well, to understand that, we need to again take a step back and understand how structure delivers, how structure changes, and which structural range you are in to understand where the real protected highs and protected lows of a range are and which ones are liquidity. So the way we do that, and the first step that I teach on this channel, is ultimately to go ahead and draw out your overall structural plays on a higher time frame basis, just focusing on one time frame. What I mean by that is, although inside this price there's this higher high, higher low, higher high, higher low, higher high, lower low, lower high, lower low, lower high, lower low, higher high, lower high, higher high, right, so on and so forth. Sorry, my dog is playing with a chew toy. Even though we have this happening and this structure is true, we're going to get to that in a second, there's also a larger structural play currently undergoing the market. Now, which one is that? Well, just by zooming out, we can clearly see that whatever push we had here ended up making this large impulse to the top side. And after that impulse was made, we had this huge impulse down. So as we do that, we already understand that currently we have this break of structure shown by this point right here. So you can draw your break structures however it is you want to. So there's a break of structure right here, which as a result puts in motion this high right here. Let's double click that as a PH, or also known as a protected high on this end, right? So we'll put that on to the right. So what we've done is we've created a protected high because this is the move that was responsible for pushing this price lower. And what we've also done is created this low, which is now the basically next target, aka what we like to call liquidity, right? Because we understand that liquidity, although it rests above every single swing high, every single swing high, every swing high, every single swing high, make sure you refer to my other video, liquidity in the market, if you do not understand this yet, and every single swing low, 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 right, nonstop. Even though it exists above every swing high and swing low in the form of buy stops and sell stops, right? What is important is allowing to ask yourself which liquidity is more likely to be ran. And that answer is created by understanding structurally where the protected high is. So where are the orders that the market wants to protect, and where are the orders that it does not want to protect because it has no interest in protecting them ultimately, right? So with that understanding, we need to understand that although liquidity exists everywhere, the way structure is moving and where they're getting involved in their orders, where they're buying to sell, where are those orders going to hold, using the ideas of inefficiency as well, because money exists in those inefficiencies that are fulfilled, and where are we targeting? So on this very large span, we understand that the target and the range that we're in exists within this overall push, okay? So this is where we get into understanding inner term structure and how that structure creates liquidity. So what I mean by that is, now what we can do is we can take this top side of structure and we can begin to draw it out on the inside, right? So what I mean by that is, let's actually go ahead and let's make this line a little bit fatter. There we go, very nice. Okay, and what we're going to do is we're going to draw out the structure present within that. So what we're going to do is we're going to almost truncate our mind to think about the inner structure without actually going to a lower time frame or anything of that nature. So what we're going to do is we're going to look at the first impulse. So we're going to see this big lower low. Then we're going to see this lower high, this lower low, this basically a little bit of a higher high, but remember it's a liquidity grab, which is fine. We're just drawing out the structure. This lower low, this lower high, and this lower low. Okay, so at this point, what's important to understand is that we've put in motion an inside structure that is going back and forth, however, is still overall bearish and has shifted bearish with the break here and the break here. And now, basically, we'd be looking at the POIs or the supply and demand zones. So in this case, the supply zones present up here to go short. And you can see there'd be some little short-term opportunities to go short. However, the main thing we need to recognize is that what we have on a lower time frame is a protected high right here, right? So let's actually go like this just for a second. So what we actually have on this lower time frame, and we can make this a little bit fatter too, just so you guys understand this. We'll go like this. All right. What we have here on this lower time frame is the same thing. We have a target of liquidity right here, which is the same target of liquidity as the higher time frame range. And we have this other protected high, which is actually only a protected high. So we're just gonna go PH because you guys understand this protected high. But this protected high is only part of this range here. So what's interesting is when price fails to hold this protected high now and shifts above it, this is the idea of displacement. So if you haven't seen the video about displacement, make sure you watch it. When we get this shift in the market and this displacement in price occurs and price pushes to the top side, liquidating all these buy stops here, what we do in essence is create a bullish short-term structure that we can now envision to run certain bits of liquidity. How do we do that? Well, at the same time as this low here is a target for this higher liquidity, it has also now become a PL. So what we're actually going to do is we're going to just delete this. We're going to make sure this is our next target. We just know that that's our next target. But what we've done ultimately, and we can zoom in to do this, right, is we've created this inside break of structure right here to the top side. And that break of structure right here has in essence created this low right here as a PL or protected low of an inside range, right? And as a result, what we've done is we've created this high here as a liquidity, right? So next area to target of the inner range. Okay, so what we do is we understand that targets exist in the form of next high or low, swing high structural plays. So in this case, what we're looking for is for this structure to continue to the top side and continue liquidating highs. So one way to view targets is just structure and structurally looking at the next highs, or on a higher time frame, structures and looking at the next lows as the protected structure and looking for that to be delivered to liquidity. But the other way to find targets is by looking inside of a previous range. So because we understand that prices still on this higher time frame push are protected at this high, that means that any swing inside of that, so that means this swing or major swing, this swing, and this swing, or even in this case this swing, but this one has been ran, all these swings, and this one's higher, so this one we can forget, but basically the inside swings, that swing and that swing, now act as a place of liquidity. Why? Because as we understand, if above every swing high is a buy stop and below every swing low is a sell stop, if smart money or the institutions want to continue their prerogative of this overall bearish structure and continue taking it short, what they need to do is accumulate more orders to the bearish side. So the way they're going to do that is they're going to run people that have begun to get into sells and have began to trail their stops to all these highs, right? Some people got in here and are trailed here, so they're out of profit. Some people got in here, are trailed here. Some people that got in here are trailed here, right? Whether you're retail or whether you're smart money, you are ultimately, if you got involved in sells, are going to have stops anywhere across these, right? Think about any trade you've ever taken. The stops you usually place are almost always above some kind of structural swing high or swing low, or above some kind of high or low made in the market, right? Unless you're using an average true range and you're trying to use the stop loss of that, you are ultimately almost always placing your stop above a swing high and swing low. And the algorithm behind institutions and smart money and the coders that they have working for them ultimately run their programs to see these points, to understand where there's more likely than not going to be a shit ton of orders, and they move price in that direction to create liquidity for themselves to go short. So the reason that we can now anticipate that this bias here can become bullish is because we understand it needs to at least run some kind of liquidity. So my next prerogative would basically say that this is almost a for sure target, right? So this can be a target 1. This is how you begin the partial. And your second target would basically be this, right? This is your target 2. So not only do targets exist in the form of just structural continuations, in the form of, for instance, retracement, continuation to new buy stops, retracement, continuation to new buy stops, they also exist in the form of a shift of inner term structure that will now create a run on inside liquidity to continue holding a previously protected high to take prices lower after distributing above the last inner term structure points. So if any of that didn't make sense to you, pause the video, go back, take notes, make it slower. Otherwise, there's a great breakdown and a structured step-by-step course available with the link in the description, launchpass.com/mentfx/mentfx. Otherwise, let's continue the educational material, okay? So we'll exit this right here, right now, right? And what we can see is that ultimately this range that began to create this new bullish price action has become bullish until we basically come to reach target 1 or target 2. And as we reach target 2, clearly we begin to shift in structure. Clearly we begin to distribute down after creating all these liquidity points. And now, as we begin to shift down, what we do is we understand that we're now on a prerogative to probably continue running this bigger ranges, target and liquidity. So at this point, if we follow the structure, right, we started creating this high, which becomes the high of a target, right, of the inside, and this protected low moves up to here. Fantastic. Then, as we make new highs in the market, which you can see pretty much here, right, the highest high was created by these protected lows. Now, again, there are going to be shifts in the market, so you can see this wick below, that happen even when they're not respecting structure. So in this case, I might have actually looked to get involved in sells here or here to go short because of the fact that we look like we shifted structure. However, at the same time, if you had witnessed this liquidity or remember that your target 2 exists here, your alert could be set right here to go off only when this begins to take it out. And as it takes it out, again, the high that we've created is this high, right? So this is just the high of an overall range, and the low that created that was ultimately this protected low. So this is the protected low of the inner range, right? Inner range. So what that means is when this protected low failed to hold the market up further and shifted, we understand now that not only have we put in a protected high of a smaller range, right? So this inside structure right here at this point, not only, we'll draw it out the right way, the way we drew it on here. Not only has this structure, actually you could have even waited for this shift right here, right? So you could have looked at this inner range right here to make yourself have better confirmation. So when this happens, we understand that now this becomes a protected high of a smaller range, and this here has now become basically the liquidity of the inner range. So now what happens is we not only ran the 2 targets of liquidity, but we've also created a protected high that from a while back, and we've now created an inside smaller range protected high. So as a result, when we now look to take this bearish structure down, we're able to trade it down with the last buys before the sells in the form of supply zones to the downside and target the next liquidity points. And as a result, we are able to have highs and lows act as not only targets, but also as liquidity, and also an area we can look for accumulations and distributions in the form of Wyckoff. And if you have not seen some of my Wyckoff videos, make sure you watch them. So this is a little bit of an extensive look inside of my previous video, or previous videos I made a while back, where we basically dealt with the golden egg strategy. And the strategy behind it was ultimately recognizing that we can zoom out on a market and see multiple structures. And when you allow yourself to see multiple structures, you will begin to understand that within protected highs and protected lows are going to be more protected highs and protected lows. And when those inside protected highs or lows shift and the market displaces against them, we can interpret that as a need for smart money to begin to run the inside previous protected highs, before we reach a target to then hold our higher time frame protected high and shift back down. And within all that, you can clearly see the multitude of distributions and the beautiful circles I'm drawing and the snowflakes. And if you've been following me for a while, you understood all that. If you haven't, you're confused as shit right now. But keep to it, stick to the process. You're learning. If you want a simplified and structured and better approach, check out the link in the description. Otherwise, start with the beginning of my videos and work through them. Thank you so much for watching. Hopefully this gave you a little bit of a more better perspective as to how to look at structure and look at liquidity and understand where it may lay and how you can target. Now, you're not always going to be correct, and I'm not even always correct, but when you refine this understanding and begin to confirm this understanding with extra parts of the process, such as imbalances, confirmation, Wyckoff, the types of schematics you're looking for, that is where the best kind of rules come from, and the best rules create the most confident and best traders. And this has been documented throughout history. So stick to the process, write out your rules, continue to refine your edge, and I'll see you guys in the next video. Thank you very much.